All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. I hope you had a fantastic weekend. Let's get to it here with the market. Something very interesting. We don't see very often at all. The VIX is up 6% this morning, right? And the normal trend is VIX up, market down, VIX down, market up, right? It's 90% of the time, that's what we see. Today's one of those rare exceptions where we see the VIX up, but the market itself also up. In fact, the S&P is up 13 points here this morning. So, very unusual action, and it tells you what. Right? What does that speak volumes to? It just speaks volumes to the fact that the market is not convinced the volatility is over. Yeah, we may get a big pop. We may get an upside action. We may get downside action. Either way, it's going to be big, and it'll probably be news related. And outside of that, investors don't have a lot of incentive to really kind of shift or move. So if you're going to go buy something out there, you really have to be protected, and you're buying up on the options, you're paying up on the options. So option pricing definitely pushing on higher here. We've talked about Caterpillar a lot over the last 2 months, that if you want an indicator for how the market feels about the U.S. Chinese trade war, boom, here's Caterpillar, right? And Caterpillar went to a new low on Friday, rightfully so, with all the trade war talk, and today not really bouncing, right? Not really bouncing. It tells you what? It tells you the market is not comfortable that there's any sort of change in the trade war dynamics. And while over the course of the weekend, we saw both China and the U.S. try to de-escalate things. Right, U.S. President Trump, after the bell on Friday came out, raised the tariffs a little bit more. But then if you go look at his Twitter, I just kind of laughed. Saying something kind of different, backtracking. Some would argue backtracking. I don't know if he's really backtracking more than just kind of speaking out the other side of his mouth, which is very normal, right? And it's something that we have heard for years now, and we'll probably hear it for a lot longer to come. So anyway, that is still all going on here. Markets have it to digest. The challenge is in all cash. We went to all cash on Friday, and we're plenty in a position to go and attack on the next signal. There are no new signals out there this morning. If you look at something like a Chipotle, it possibly has a 3-7 upside crossover, but nothing where consolidation risk is low enough to not trigger. And there are no downside 3-7 crossovers this morning as it sits. So nothing to jump into. Normally Monday mornings, not a whole lot. So I'm not too surprised, especially given the environment that we see out there in the market right now. Want to go out and take a look at this concept of wall of worry here with you this morning, because I think this is what the market, if you're looking at market timing or saying, well, what, when's a bottom, when's a top, what's the market going to do next? Yes, there are technicals, there are fundamentals, there are all those things, but let's face it. Right, the technicals will ultimately go the way of how market participants feel about things and how some of the news cascades and falls. Yes, the technicals will give us what some of the probabilities are and show us some of the price action, but it's never a, hey, you know what, it's a dead certainty to go up or dead certainty to go down when it comes to technicals. And even on the technical front, we can make a pretty good argument that 200-day moving average is coming, right? While we can say, well, you could buy today with a stop on today's low, and you can make a whole lot of different technical assertions there. But I think it's very important to kind of understand what fund managers are thinking, how they're looking to react, and how they are positioned. When we look at some of the data for funds over the course of the year, funds are not in a huge lag position, right? They were back here in February and in March. They were in a big lag position. I do think that's one of the reasons we saw, a new high come into June and July. But we're not seeing funds in a big lag position where they have to chase. They can't miss the next rally, which is a different kind of tone for the market than what we've seen in other areas, right? What does that also mean? It also means they can ride a little bit to the downside, right? If they're performing with the market and the market falls 10% and their fund falls 10%, it's not going to cost the fund manager their job, right? If the market rallies 10% and they're not in, well, it is going to cost them their job. So it's one of those where, I still think there's more money to come in than to go out based on how the fund managers are positioned. Now, does that mean they're jumping in? No. They need some sort of catalyst to jump into. They need some sort of reason to get behind. And normally when we see a market setting up in this type of way, it comes down to this wall of worry. And the wall of worry is an interesting concept. You hear that phrase out there in the market: buy when there's blood running in the streets. Sell when there's people pounding at your door. There's all sorts of variations on that. But, the wall of worry is one of those that really kind of helps to see, okay, is there enough blood running in the streets? I was asked on Friday, hey, is this blood running in the streets? And is this a time to buy? And I said, yes, it's bloody out there. But when you compare this to other things, I mean, that's just kind of a one-day drop. It's not really all that bloody, right? We don't have, people just clamoring to, get out of things in the ways that we have seen even back last December, right? So a very different type of environment here in terms of this wall of worry. We're not seeing the full wall of worry realized, but let's go take a look at it. What are the components of the wall of worry? Well, some of them are easy. One, the Fed, right? What's the Fed going to do? Is the Fed going to, cut rates? Are they still stuck on tightening, right? The Fed is not on the side of the market right now. That is, we talked about that shift about 2 months ago. The Fed is not on the side of the market. Yes, the Fed has incentive ultimately to push the market higher, but it's also not one of those where they are in such a position where they have to kowtow to the market in a big way right here. And in fact, if you look at some of the political factors that have really come into the Fed, we've talked about this kind of politicizing of the Fed here of late. It's one where you could almost argue that the Fed has more incentive to not cut rates than to cut rates. And I don't know that we've ever seen a period of economic data erosion where the Fed has had, Fed hasn't had incentive to cut rates. And this is one of those where they simply might. And it's because of some of those political factors. But it's a worry, right? It's an unknown. A lot of different things could happen. It's not one of those things that you can sit back and predict and go, well, they're going to do this, this, and this, and this, right? Yeah, we can guess. We can have general ideas. But it is not a foregone conclusion of what path they are going to walk. The other obvious one is the trade war, right? And we see the different developments, shake out and happen. We have seen the market have to deal with, stuff like this in the past, and in terms of even Greece and Europe and all of that kind of stuff, where things were a lot more volatile, right? The trade war stuff has, yes, it's created some more volatility, but nowhere near the volatility that is historically high. And it's one of those where, okay, predict what's going to happen next, right? We can guess, we can have a good idea, and the bottom line is both parties have incentive to resolve something, but neither party has to resolve it right now. right? So there's a time element there in the trade war, and I think the market overall is looking and saying, okay, we are comfortable the trade war will ultimately end. Just when? Just when is this going to happen, right? Another piece of the wall of worry, and we don't see it talked about a lot, is Brexit. We're coming up in October onto a hard Brexit, so that is something that could, most certainly impact things. Another one, and this is one we're not seeing talked about very much, but earnings estimates for 2020. You could argue the earnings estimates for 2020 are really high, given what we are seeing from an economic data standpoint. And while every time we go into a new year, into a new quarter, we do see analysts downgrade their earnings estimates or ultimately bring their numbers down, I think the case can be made that those 2020 numbers are going to have to be brought down in a big way. And this is something that is just kind of starting out. We'll kind of see how it plays on out, but this is going to be a worry for fund managers going through the second half of this year, is what's going to happen to earnings estimates for 2020. Are they going to stay where they are? Are they going to be lowered? And if we go and we look at the next earnings season, companies have a great excuse to lower their earnings estimates for 2020. Are they going to take it, run with it? And if so, that could have a serious impact on market value, right? Another one, inversion of the yield curve, right? Inversion of the yield curve. None of these in and of themselves are enough to drive the market completely, down. But when you look at these, the different things the market can be worried about, there's a lot going on. And then for one of the things that's starting to come in is U.S. election risk, right? Who's going to be the next president? Who's going to have control of, the House? Who's going to have control of the Senate? All that type of stuff is going to start to come into play. And, so that's one of the other, another one of the wall of worries here. We could list out a whole bunch of other stuff, but with these 6 things, let's take a look. Are they escalating or are they de-escalating? Meaning, if we look at the wall, if we look at a worry factor, right, there's this curve where, there's no worry down here, okay? This is up here is the highest point of worry, and then down here, okay, the worry goes away, right? And in terms of how the market prices things in. Where are we on this scale? Right? Are we at the point where the market is priced in the highest amount of worry? Well, when the market prices in the highest amount of worry, that's typically when the market hits a low. Okay, so where are we on this curve? Is the market building in terms of the wall of worry and more worry coming in? Or is it, okay, the market understands it, the market knows it, it's now accounted for it? When it comes to the Fed, we are absolutely on the upslope with the market trying to figure it out, trying to understand where the Fed is coming from. We are absolutely on the upslope. With the trade war, you know what? I think there's a good argument to be made that it was de-escalating. We were on this downward slope, but the events over the weekend, switched that in a big way. And we can see them flip-flop, but, trade war, well, there could still be a lot more worse priced in. Brexit, we're absolutely on the upslope here for what's coming in October. The full breadth of that has not been, priced in, has not been, understood. The earnings estimates for 2020, that's a new thing starting to creep in. The inversion of the yield curve, that's a new thing starting to creep in. U.S. election risk, we're probably down here. And so if we look at the big factors for wall of worry, most of them are on this element of ascent rather than topping or descending. And I think that's we can argue where it is. Is it right here? Is it right here? Where are things on this wall of worry? But when we look at all the different components, I don't think we can make a good argument that they're all fully priced into the market, and that they are something that the market can kind of say, oh, okay, that's past us, right? And what we tend to see in the news cycle is after we hit this high point of the wall of worry, the news cycle is still heavy with those things, right? But the market's already priced them in. Market's already dealt with them. So while the news is running with them, the market really isn't reacting here to them. And we don't see the news really running with, some of the earnings estimates for 2020, Brexit stuff here. Yes, trade war, it's front and center each and every day. But when it comes to this wall of worry, I think we can make a really good argument that there's more to come. There's more blood to run in the streets. Now, what does that mean from a trade standpoint or from a market standpoint or something like that? It simply means, look, if you're wanting to step in and buy today, right, you can, right? There's nothing to stop it, but you have to factor in the downside potential. And fund managers are forced to do that here today. And we're not seeing a lot of, big buying come in. This is a gap that is changing prices more than buying versus selling. Where Friday it was selling that took things down. Today it's a gap, and you can argue there's been more selling action in the market today than buying, even though the market is up. But when we look at this, could you be a buyer? Sure, but fund managers have to look, and they have to say, look, you know what, the risk of getting a lot lower is significantly higher than what it's been. You could argue the entire month of August. And so they have to kind of look at it that way. Fund managers, they're not really, in a position where they have to get out. They can ride some of this, but when we're in that type of thing, they do ride some, but they even hit limits where they say, okay, you know what, line in the sand, I got to just get out and wait, right? I think for fund managers to really be forced back in, we're going to need some sort of exhaustion and bounce, or we're going to need to see some sort of game-changing breakout above 292 on the S&P and, see some sort of, gap action or forced chase action come in. But for the most part, without any news, heading into Labor Day weekend, heading into the kind of lulls of early September, without news, we could see this market, really have some pretty monster swings in it without, the monster volumes or even without any sort of game-changing news. So bottom line, wall of worry continuing to climb, volatility higher, and I think what we saw, Friday of last week or what we saw last week was an opportunity for that wall of worry to kind of start to go down. Had the U.S.-China trade stuff gone a different direction, and had the Fed maybe made a few different types of comments there, I think we could argue, look, the market would have been in that breakout mode in that area where fund managers have to chase in. But we did not see those dominoes fall that way, and so we are back into this kind of, not kind of, but back into this situation where lower is the path of least resistance. Higher will need a catalyst, to come with it. Okay. Alrighty. Hopefully that helps just kind of understand where things are. A lot are kind of, okay, when's the bottom? When's the bottom? For me, it's one where, go look at call prices, right, this morning. They're really high, right? So even if you're right and you play calls up a little bit, you've got to be right in a big way to pay them off. So it's not very much of an incentive. I do think this morning's a very interesting time to look at puts, but it's also one of those where you have to realize the pricing's very high as well, and that if you're wrong and the market bleeds higher, those puts are going to get clobbered. So, it is definitely a higher risk scenario out there, both in terms of direction and in option value. And, look, if we break Friday's lows, we're definitely coming to a lower Bollinger Band, and I would not be surprised to see it overreact down here to the 200-day moving average. All right. So that's kind of the wall, or that's the wall of worry, kind of what we're seeing out there, here today, you kind of see we saw a 20-point bounce right into the close on Friday, right? There are plenty more 20-point swings to come. I expect to see a couple here today, and I do expect to see a couple more as this month closes out here for the S&P. Thanks for hopping on. Have yourselves a great day. We'll talk to you this afternoon. Take care.